Take two. I am Russell Faucette of the Stern team of Omada Real Estate here today with Mandi Henriod of Wise Home Lending. And we are just here to kind of get an update on the market, what's going on and what you can expect to see in the real estate and mortgage world. So this week, two big things I think that are affecting our world.
Yeah.
The first one was, so today is Thursday. The first one was on Tuesday of the Trump tariffs with Canada, China. There may have been some other ones, but
Those are the big names.
For our world, I mean, in production of housing, Canada I know is a big one, but help us I guess for those maybe that don't know what a tariff is, explain what a tariff is, and then how does that affect mortgage interest rate? Why do we care?
Yeah, why does it trickle down to real estate? So a tariff is essentially a tax being charged to the country that is importing goods into our country. Seems reasonable. What happens when we put a tariff in place is then the country that is importing in has to raise their prices to cover that tax. That good comes into the U.S. The consumer will pay more for that good to cover that tax that's happening, right?
Okay.
It's being done to drive more industry and employment into the U.S., right? There's so much that's been outsourced at this point. Having said that, there's a lot of things that we get from other countries. And when consumers are paying more for goods, that is the equivalent of inflation, right? It's rising prices.
Yeah, the cost of the same product is now more, and
right,
so that is inflation.
It's like everybody and their eggs, right? Those are like gold now,
right?
Right. If it costs more to buy them, it reduces the amount of people who can afford to buy them, but also it's inflation. It's the cost of goods that have gone up. So when that happens, that is one of the things that the feds have been fighting against this last couple of years. Is in the pandemic, rates were down in the 3s, 2.5, right? We did some crazy loans back then, and in doing so, there was just this flood of money into the market, and which creates inflation, right? Cost of goods starts to rise. So the feds have been raising rates and holding them high to combat inflation. And inflation's actually pretty close to a healthy spot right now. We're not unhappy with where it is. But the feds look at tariffs and they say, we don't know. We haven't seen the impact yet. We don't know. We've never been here before at this level. Is that going to increase inflation? And if so, then the feds are going to want to hold rates high.
Yeah. And I think the other side, so we have the interest rate side, then we have the true cost to the consumer, right? So you can look at this globally, which is kind of more what the feds are doing of how is inflation, what's that rate? But, we also have to look at it as what is this going to cost the consumer? Because it will, lumber, steel, all of the things that we're importing, those costs will go up. And who's going to cover that? Is it going to go to the consumer? Are builder margins going to get smaller? More than likely, it is going to go to the consumer, which could drive up the cost of a house for new construction, which would then drive inflation a little even more. The thing about that is then do we create a gap between new construction and existing homes?
Especially in a market where you have a housing shortage.
Right. So then all of a sudden new construction goes up. Everyone moves over to existing homes. We have a housing shortage already.
Right.
So
we need our builders to be thriving.
Right. And so that'll essentially then drive the price of existing houses, or it goes to the other extreme of it just completely, it gets too expensive. Fed rates held, higher, costs go up, and it just gets too expensive. And then how long can we, how long can we hold before prices start to come down? And because so many people have that 3%, we've seen it. The prices, even though we've been in a housing recession in the number of sales, all the way going back to 2022, June of 2022, prices have held steady. Because there's just not.
Well, think about it, right? When the housing crash happened, there were lots of variables, obviously, but part of it was that people, when they lost employment, couldn't afford their houses.
Right.
In this market, if you have that 2.5%, 3% interest rate, you can't rent for that.
For sure.
So you're leaning in and you're keeping that house.
Well,
so we have not seen a drop in values because nobody's moving.
Right. And where we're seeing it, you know, the other places, and I was back, I did short sales. You know, I was part of that. I was right in it in the middle of the last crash. And when I was going through and looking at people's finances, they were choosing to let the house go, and they were keeping the car, and they were still eating out. They were obviously, some people, yes, I mean they lost everything, and so they had to cut out everything. But there were a lot of people that were choosing to let their home go. This time around, it's like bye-bye $700 car payment. You know,
and renting out rooms or whatever they have to do to keep it, because they know they can't rent for.
They can't rent. They can't buy another home. Like, they can't really even sell and downsize. Like, so it's, what do we have to do to keep this house? And so that's keeping inventory off the market.
Absolutely.
Okay, so tariffs still kind of an unknown, because this could be a negotiation play, and 3 weeks from now the tariffs are gone, or this could be a long-term play to bring jobs and manufacturing back to the U.S. That's still
there's no way to tell.
It's really an unknown. But what I thought there would be a bigger response on, like, a swing in the mortgage rates, right?
Interesting, yeah.
And we didn't see much of a change.
Not substantial. We had a very, very small uptick this week, but it was not substantial enough for us to even have a quick locking frenzy for clients.
Which is interesting that they ticked up, because I thought, you know, I understand it, but kind of the general knowledge is when there's uncertainty and
rates get better.
Considering bad stuff, like, rates would get better. But in this, they actually ticked up a little bit.
And in general, rates are substantially better right now.
Okay.
Right now, rates are phenomenally good compared to where we have been. When I say a slight uptick, I'm saying the same interest rate maybe costs an extra $130, right? Very, very minor movement. But inflation actually is something that will make interest rates rise, because the feds will raise the Fed fund rate to combat inflation. So if the tariffs were to start causing inflation, we will see the market correct higher instead of better.
Got it.
It is the one place that is counterintuitive. Typically, negative news, better interest rates.
But the interest rate today is still substantially better than where we peaked out, right?
We actually are sitting in a really healthy market right now.
Okay.
Conventional in the mid sixes, FHA, government loans, high fives. We're actually in a very healthy market.
And then I would assume you're still seeing some buy downs and things like that.
Absolutely.
Because, buyers can go and negotiate that. And so we're really at that point of, we're at a good, if you look over, history, we're at a good spot for interest rates.
We are. Yeah.
And really, because of the shortage of homes still, and yes, there's news sometimes can confuse people, because it's like, yes, there's 5 times as many homes as there were during the pandemic, but the pandemic, there just weren't homes. We're still at historically low, a shortage of homes. So if interest rates come down too low, we're going to see another run on prices.
We're already seeing a little bit of this, right?
Okay.
And you're experiencing it, right? Your agents on your team, there's multiple offers on a property again. It's because there's just not a ton out there. If you have a good property, there's still pretty high demand, and rates are finally in a point where people can kind of wrap their brain around them.
Yep. And when you're looking at interest rates and prices, there are very, very few times compared to a mortgage payment. So when interest rates come down, typically home prices go up. And then if rates go up, home prices might come down, but usually you end up with a little bit more negotiating power. Even if the prices aren't coming down, you can get closing costs, maybe that buy down. But over time, if we look at it, if you're not paying cash, payments historically go up.
Absolutely.
And so that's why, you want to get into the market. It's the only way you can actually bring that payment down substantially would be to go in, buy today, pay down some principal, refinance later to reforecast, or if interest rates, if we
Yeah.
have another historic moment.
Yeah, if we have, take advantage of it, by all means. I did do the math at this at one point when rates had risen, and I had a lot of clients saying that they were waiting for the rates to come down. And I did the math based on a $500,000 purchase. I assumed a 4% appreciation, which is kind of a standard healthy
Right.
appreciation here in Utah. The difference a year from now, if you got that home with an interest rate that was 1% lower than today, but the purchase price was 4% higher than today, it was a $16 a month difference in the payment. $16, and you missed all of the equity upswing of like $20,000 to $25,000.
Right. And
so
that's crazy, because the way my brain thinks
think
about it is like, okay, let's say I was investing.
Right.
And you came to me and said, Russ, this investment's going to cost you $16 a month. And in a 12-month period, I'm going to return $20,000.
You would do that all day long.
There's no one that would turn that down.
Right.
But
it's counterintuitive to what we think, right? We feel like if the rates were lower, it'd be more affordable. It's catch-22. And we saw it here in Utah on a very high level during the pandemic. Rates were so low, but prices,
right?
Then the uptick in prices was substantial and very fast.
Okay, so the other big news actually happening today is jobs report. So kind of where are we sitting in the market? Why is it important that we're watching jobs report? Why do we care?
So jobs are a big important mover in the interest rate market because it's a sign of the strength of the economy. So when unemployment is higher, it's a sign of weakness in the economy. The counterbalance to that is interest rates, right? If the feds are trying to boost the economy, they're going to lower rates. So we are like an absolute seesaw. Other than inflation is our one spot that is different, right? Other than that, everything else, if it's bad news on one end, it becomes good news on our end.
Yep. Okay, and so right now are they predicting that we're going to see a good jobs report, or are we seeing some uncertainty and layoffs?
Yeah, there's definitely, the jobs report has been a little bit weak, not just in the government sector, which is the piece that everybody would think is the thing.
Right.
There are some other sectors, including technology, that jobs reports are looking a little weak.
Yeah.
So
that's
good for interest rates,
right?
Not great for jobs.
Right. And with the tariffs, I think, what the Fed has said, they're probably, they may lower rates 1 or 2 times this year, but if they do, it's not going to be like a we're
not expecting it to be
probably like a quarter point, right? And so with that quarter point, tariffs, unemployment, GDP, all of these things actually can make bigger swings up or down than the Fed
than what
changing.
The Fed fund will change.
Because outside of something that unforeseen event, the Fed rate, yes, may go up or probably down this year, but not substantially enough for that to be the driver of what's affecting the interest
Correct.
rate.
And I think the expectations will still see the Fed be fairly conservative in that movement, right? I think they've learned a hard lesson after pandemic. It took a lot to get our inflation in check.
Yep.
That was a long, hot moment to get inflation down. So I think they're probably resistant to coming in to rescue everybody by lowering.
Think the other thing we just talked about, the mortgage rates are actually at a healthy level.
Right.
They're
30 years in this
rate.
business, rates are actually pretty good right now.
And so, I actually, yes, I want them to hold a little bit and wait for it. Our jobs actually have been very, very resilient. We've been watching that since they started raising rates. It was like, okay, is this going to cause a recession? Are we going to crash? And so far, no.
Right.
Housing prices all the way through have held strong. Right. And so it's one of those that
the thing that so many buyers were counting on, right? They were like, well, rates have gotten high, prices will fall. We had a very, very small correction, but we didn't lose ground really.
Yep. Okay. So again, still a lot of uncertainty out there.
Yeah.
Maybe some swings. You'll obviously watch, and you're right in of hey, this is good, let's lock, right?
Yeah.
And so each week we're going to come to you with market updates, keep you up to date on everything mortgage and real estate. If you have any questions or any needs, definitely reach out to myself or Mandi. We'll put our information in the comments.